This is about quick tips for quick cash. This applies to so many people, whether you're just starting out or even if you have a lot of money. I just wanted to think of the fastest ways to put money in your pocket. We're going to start with property and casualty insurance. Yeah, that car, homeowners, renters insurance. What you can do very simply is call and find out what happens if you raise your deductibles. How much will it lower your premiums? You can either save money or even increase your limits of liability to be better protected. So instead of having small amounts of coverage, $100, $500, $1,000, if you move that up, then you can get limits of liability. This could be hundreds of thousands of dollars instead of hundreds of dollars. Or it just puts more money in your pocket because if you make a claim, they're just going to raise your rates anyway. So use it for the catastrophic. That's the concept. Catastrophic, not the inconsequential. Here's what inconsequential means. You have the cash to pay tomorrow without losing sleep over the cost. If you don't, then you might have to have lower deductibles until you can build up your savings. See, making more than one claim on your insurance will always raise your rates, and making multiple claims creates risk of being dropped. So handle the small things yourself and save money by increasing the deductibles. Now, there's additional ways to save on insurance. If you utilize the same company for your car and homeowners, you get a multi-policy discount. You can consider an umbrella policy, also known as an excess liability policy, and carry the minimum limits of liability on your car and home for the umbrella coverage to begin, therefore being more efficient with your coverage. Here's some insurances to consider eliminating. Accidental death and dismemberment and mortgage insurance. Instead of mortgage insurance and AD&D they call accidental death and dismemberment, just have regular life insurance that covers all situations. You can drop credit card insurance, which disability insurance could cover, or your life insurance could cover, or flight insurance. I was trying to get you to take that, or rental car insurance. If you already have car insurance, often it will be covered. So if it's already covered, don't have that duplicate cost. If you don't own a car, therefore you don't have a car insurance, then you might consider rental car insurance, right? That's a little different situation. Another one is private mortgage insurance. If you don't have 20% down when you buy a home, you can use a second mortgage for the down payment to avoid PMI or private mortgage insurance. That could be very helpful, and you're not paying just for the banks to be protected. All right, the second quick tip here is to use the cash flow index, which will help you shave the time it takes to pay off a loan without having to cut back. The formula of the CFI is your loan balance divided by your payment. Loan balance divided by payment. Whatever has the lowest cash flow index is the one you want to pay your extra money to, and only pay extra to one loan at a time. Then the one with the next lowest cash flow index, once that loan is paid off, you could kind of do the waterfall thing and move to that. So there's a 3R method to improve your CFI or cash flow index to save even more time and interest on paying off your loans. Number one, you can restructure. Could you refinance low CFI loans to have a higher CFI? Higher CFI means it's a more efficient loan. It's not as hard on your cash flow. Maybe it's a car loan that you refinance. See, a car loan is an installment loan, which is a fixed payment and term. That can actually improve your credit score. And when you have collateral of a car loan, then you can actually lower the interest. Home equity line of credit or home refinance might be another way that you could pay less in interest, right? This can create tax deduction interest, and it can also lower interest rates because there's the collateral of the home. Second R is to renegotiate. Call it credit dressing. Optimize and improve your credit score. I'll give you some ideas on how to do that. Then call your credit card company and ask for the following. Ask for new offers or deals. Ask about balance transfers. Ask, tell them you're considering canceling or moving to a different company. They move you to the retention department. And when you're at the retention department, you can usually negotiate a better rate. The third is reallocate. Really simple on the 3R of reallocation. Do you have any underperforming assets that aren't earning as much interest as the loan interest that you're paying? Just pay that off. Example might be a 4.5% rate on a certificate of deposit and a 12% rate on a credit card. Cash out the CD, pay off the credit card. You got the CD money to pay off the credit card, now you save the difference. Or maybe there's ways you can more borrow from yourself at preferred interest rates, cash value and insurance, retirement plan loans, or even family members. Now, one of the things I mentioned was dressing up your credit, which is improving your score. So I mentioned having an installment loan over a revolving loan. Revolving loan is like a credit card, where an installment loan is like a car loan. Installment loans are fixed amounts and payment, and so they'll be paid off in a specific time. Revolving loan, you can use more or less, pay it down, use it again. And if you don't have the best credit score, you can have 3 to 4 credit cards to limit your utilization to no more than 30% of the full amount available to you. And when you keep that utilization rate down, it'll help improve your credit score. So if you have a $1,000 credit card, don't use more than $300 if possible. And then you can, over time, increase your limits to your credit card so you have more credit available, which that availability can help your credit score. So check your credit card limit. If they're not showing that you have a available balance because any amount borrowed looks like it's maxed out, it means you just have an error in your credit report and you need to fix that. An example, if you've only borrowed $3,000 on a $10,000 limit, but the report shows you have zero available balance, that's the error to address. Check for other errors that could impact your credit score: a misspelled name, improper reporting, something in your credit score that's not actually yours, a wrong address. Some additional credit tips is limit your hard inquiries, which is allowing other people, like a third party, to check your credit. If you're opening a bank account, getting a credit card, a mortgage, or a car loan, you can have soft inquiries, is where you check your credit. It's no impact to your score. The final one, number 4, I want you to find unclaimed or lost money that's rightfully yours. Go to missingmoney.com. See if they have any money that didn't make it to you for a number of reasons. Maybe it was a paycheck after an address change. Maybe it got mailed to the wrong address. There's a 1 in 7 chance, with the average savings being $1,000 or more. I've had this happen over and over because of, moving to a different home or to a different office, or, the chaos. I had some business partners die long ago, and so a lot of the mail was getting sent to a different place as I was officing out of their office for a while. Who knows what it could be? But that's 4 very quick tips. Look at your insurance and what your deductibles are. Look at your interest and loans and what you can do to improve that using the CFI. And then look at this missingmoney.com and see if there's something right there that's available for you. Hopefully this puts some money in your pocket and some peace of mind back into your life. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from. So go ahead and click through and watch the next video now.